The stock market crash of 2008 was very influential to the history of our economy and our country, as well as the effects on the present and what we learned from it to help us go into the future. Hi, I'm Josh Swanson, and today I'll be talking about the causes, the effects, and what we learned from the stock market crash of 2008. First, we have the causes. There are three big causes. You have subprime mortgages, bonds, and CDOs. Subprime mortgages are basically mortgages that are higher risk and higher reward because they're mortgages that are that much less likely to be paid off. They're bad in the sense of, credibility, but they have that much more payoff if they turn out okay. Mortgages in general are a great investment opportunity because they're very reliable, and that was also one of the mistakes of investors and investment banks, is because they relied too much on their and they overstated the reliability of mortgages. What led to the issues with subprime mortgages was, number one, there was a greed of third-party sellers. So investment banks would allow third-party vendors to come and they would sell mortgages, and they would sell subprime mortgages, and they were incentivized to sell as many as they can. So they could sell 5 mortgages to one person and make a lot of money off that one person because they sold 5 of them to him. They were selling to people who had lack of credentials, people with terrible credit scores, with low income, faulty jobs. They were going back and forth between jobs. They were in unemployment. But what they would get, or how they would sell these mortgages to them, is through low interest rates. So they'd say, I'll give you 3 different mortgages at 2% interest rate for each of them. And it won't increase, but in fact it did, and I'll go into why that was an issue in later slides. Then we had falsely rated bonds. Private firms were responsible for rating these bonds. So the investment banks had, and this is a part of the issue, the investment banks had, power over these private firms. So these private firms would go to the investment banks and say, listen, we will rate bonds for you if you pay us. So that's how they got their income. That's how they got their profit. However, the investment banks were huge, and they would go to these little private firms and say, listen, we're going to go find someone else who will rate it the way we want to if you don't rate it this way. So they would use their power, and they would force the private firms to rank bonds in certain ways that they wanted them to. This would cause bonds to be inflated. As you know, bonds are rated in using 3 letters, and then there's AAA, AA, and single A, and then they do that for B's and C's as well. And the lower it is, the worse the bond is, but the more risk is involved and the more payout is involved as well. The only problem is they were rating bonds that were, say, single C as double B's, and someone might look at the double B bond and say, okay, it's got some risk there, but I've got some payout. The only problem is these are triple C, so these were about to default. So now they were investing in bonds that weren't going to get paid out in the end. We also had exploitation of CDOs. CDOs are basically, it's a gamble. So you're looking at this time, the real estate market was great. I mean, you've got demand skyrocketing. Mortgages are growing great. So the CDOs are basically betting on the real estate market. So the problem was with the CDOs is they relied too much, again, on the reliability of the mortgage and the marketable securities as a whole. So the first CDOA placed a bet on the mortgage-backed securities, and then CDOB was within CDOA, and that would make a bet on CDOA, and then CDOC was within CDOA as well, and that would make a bet on CDOC. So people had CDOs within CDOs within CDOs. Those are called synthetic CDOs, and they were just creating bets on bets and bets, increasing money. But the problem was they all failed because they were misstating risk. Because since the 1930s, the mortgage industry was, super reliable. It kept going up, and recently in the early 2000s, leading up to the 2008 crash, the real estate industry was looking great. Prices were high, demand was high, things were going great. So it was a healthy investment, but the only problem was they misstated the risk. And they said things were going to stay the same forever, but that's not true. And then there was the big burst. And like I said, there was fake interest rates. So interest rates actually weren't at 2%. When they would sell an individual a subprime mortgage, they weren't actually 2%. They were actually 6%. But so the person would end up defaulting on the mortgage and not being able to pay it. So basically, it was a lie in the numbers because there was so many subprime mortgages, but in fact, there was almost none because people weren't paying them, and then that led to an oversupply of the houses because people couldn't pay their mortgages. They got kicked out. The bank took the house, and then they were on the streets. But these houses were just left empty with mortgages yet to be paid. So there was an oversupply of houses, and then that even led to prices absolutely plummeting for houses that were already in the market. And then this caused, again, like the subprime mortgages to default, which caused the burst in the housing market bubble. Now I want to talk about effects. The big one was the closing of investment banks, specifically Lehman Brothers, which was a huge investment bank with over $316 million in assets. The economy was hurt for years, and the jobs and retirement plans were ruined. So the Lehman Brothers was a huge investment bank, and their stock price plummeted 93% in one day. So from the time, say if it was a Tuesday, from the time on Tuesday morning when their stock price was at $93, it went down to $4 in one day, and then they declared bankruptcy later that day. And they went bankrupt due to subprime mortgages because right before going down, leading up to 2008, they bet on more mortgage-backed securities than any other firm. This was huge because many jobs were lost, money was lost, investors lost money, and the economy was hurt by Lehman Brothers alone. Unemployment peaked at 10% because of this. 2.6 million jobs were lost. $2.4 trillion were lost in 401ks and IRAs, again, due to investment banks like Lehman Brothers being completely liquidated. It took 10 years to fully recover, so it wasn't until 2018 that our economy was completely recovered from the damage. There was a massive recession for years, and then on average, those homes, like I was talking about with the fallen prices, those homes lost a value close to $100,000 on average. So summary, there was a miscalculation of risk from the beginning of the time, whether you're looking at the subprime mortgages, or you're looking at the bonds, or you're looking at the CDOs. There was constant miscalculations of risk, and there was constant misjudgment on reliability. The subprime mortgages were the main cause because there was a huge demand for houses with lots of subprime mortgages being offered, but no one paying the money for the mortgages being offered. And then CDOs, like I said, there was a misstatement of risk, and there was constant money just getting flowed into the CDOs with no understanding about the risk that's involved. And then again, it just goes back to the human nature with greed of people with the investment banks forcing the private companies to rate bonds falsely. It's just the greed of people that have access to money and power. But we've learned a lot. Many people were incarcerated. They took huge, powerful people and put them in jail. The FBI did lots of investigations. Big senior managers in the Lehman Brothers were put in jail, and Congress also put a lot of acts and laws into place to make sure that something like this never happened again. So people couldn't lie, people couldn't manipulate the system, and people took calculations into perspective a lot more carefully. Thank you for listening. Hope you have a great day.